All right, today we're digging into Johnson & Johnson's latest earnings, and folks, it's a real head-scratcher. They posted a great quarter, beat on revenue, the CEO is talking about double-digit growth, so why did the stock tank almost 3%? Let's break down this classic Wall Street puzzle.
Okay, so let's get right into the numbers. First up, the bottom line, adjusted earnings. J&J delivered $2.46 a share. No drama here, that's exactly what Wall Street was expecting, right on the money.
But this is where it starts to get interesting. Take a look at the top line, the revenue. It came in at $24.5 billion, which blew past expectations by more than $400 million. That's not just a little beat, that's a solid beat, a clear sign of real strength.
And it wasn't just the numbers that looked good. The tone from the top was incredibly bullish. You had the CEO, WimDato, calling 2025 a catapult year for the company. I mean, that's some pretty strong language. Then he doubles down, saying they have a clear path to double-digit growth. That's a very bold message to send to the market.
So let's recap. You've got a strong revenue beat, earnings are right on target, and a super confident CEO. You'd think the stock would pop, right? Well, nope. Instead, it dropped nearly 3%. So what on earth is going on here?
And that brings us to the core puzzle, what we're calling the investor tug-of-war. It's all about why a perfectly strong report led to a weak stock price. Let's get into it.
Okay, so what we have here is a classic Wall Street standoff between future promise and present-day problems. On one side, you have the bulls, the optimists. They're looking ahead at that really strong 2026 forecast. They're looking at a red-hot oncology division that grew a massive 21%, and they see this pipeline just brimming with new drugs that could drive the next wave of growth. But then you've got the other side of the rope, the bears, and they are focused on some pretty serious clouds on the horizon. The biggest one is their blockbuster drug Stelara losing its patent protection. Now that's a huge deal. It means a flood of cheaper generics is coming, and that's going to take a big bite out of sales. Add in some fierce competition in their MedTech business, and, oh yeah, the fact that the stock was already up 13% before this report, and you start to see the problem. For a lot of investors, it just felt like all the good news was already baked in.
So that's the battle. But where do we go from here? Let's put on our analyst hat and make the next call for the quarter ahead.
All right, here's our take. We expect the company's results, revenue and earnings, to keep tracking right along with that ambitious guidance they gave. No big surprises there. But the stock price? That's another story. We see it being stuck in a range for a little while. The market is in what we call a classic show-me mode. Management made some big promises, and now Wall Street is basically sitting back with its arms crossed, saying, okay, prove it. And that really gets to the heart of it all. J&J is a giant company in transition. They're trying to prove that all their new innovations can more than make up for the hits they're going to take on their old blockbusters. So because you have this perfect stalemate, these really exciting growth drivers on one hand and these very significant headwinds on the other, our outlook right now is best described as market perform.
So ultimately, the big question for any investor is this: can J&J's new chapter be more profitable than its last? The answer to that is what's going to determine if this stock can finally break free from this tug of war. And as always, remember to do your own research because this is not financial advice.